Hello, everyone. Thank you for joining us for another San Francisco Bay Area housing market update. My name is Oscar Wei. I'm a senior economist and the director of research at the California Association of Realtors. It's a pleasure to be here to share some information with you about the latest economic and market update. Now, we have been staying at home for the last 3 or 4 months or so, and of course, things have changed. And the housing market, though, it looks like it's getting a little bit better compared to what we experienced a couple months ago. So we're going to go through some of those latest updates, latest market conditions. But before we do that, let's take a look at the coronavirus pandemic situations. As many of you know, in the last couple of weeks or so, we have been seeing some uptake in terms of new cases and also people being hospitalized. And so we need to take a look at what's going on and see if we can understand a little bit more. So just based on some of the numbers from the state of California, we got the new number of cases of positive cases actually exceeding 200,000, 220,000 in the latest statistics that we got on June 29th. There have been a lot of new cases in the last couple of days or last couple of weeks, in fact, since the state reopened. In fact, for the last 3 or 4 days, we have been constantly getting 5 or 6,000 cases on a daily basis. That is somewhat alarming and very concerning. Now, part of the reason, of course, is because we have more testings. We have increased the number of testings in the last couple months or so, and as such, we see more new cases. But at the same time, we are also seeing an increase and uptake on the number of positive cases. Number of positivity rates actually has gone up. A few weeks ago, I think in the early May, we had the positivity rate at around 4.4, 4.5%. But lately, it has gone up to 5.6%, meaning 5.6% of the people being tested were tested positive. That's not a good sign. I think we can say yes, there are more testings being done, but at the same time, since the reopening, we probably have a little bit more personal interactions. People may be a little bit more relaxed with social distancing and maybe a little bit more relaxed with wearing their face mask. And as such, we have, as I mentioned, more people being hospitalized. A number of hospital patients also surged significantly, as you can see from the chart on the left-hand side. It actually went up quite steeply in the last couple of weeks or so. If the trend continued to go on, the state will probably have to go back and do a shutdown again, and that's not what we want to do. So we want to make sure that we continue to practice social distancing and make sure that we do our due diligence and keep this pandemic situation under control. And if that's the case, then we can hopefully get the economy back to a little bit more somewhat quote-unquote semi-normal, and then we don't have to have a lockdown again. The pandemic situation also obviously have done a lot of damage to the public health, but at the same time, it has also done some serious damage on the economy. You probably have seen a lot of numbers, but let's take a look at some of those numbers that we have seen in the past couple months to see how big of an impact it has. Now, if you look at the GDP, the economic output that's being released on a quarterly basis, you can see from this chart that in the first quarter, for the first 3 months of the year, we actually had a decline of 5%. Now, 5% by itself, may not mean anything, but if you take a look at the slide here, this is actually the biggest decline that we have had in economic output since the last recession. And keep in mind also that the decline of 5% is sort of a result of just the last couple weeks of shutdown. With the last couple of weeks of shutdown, it already caused the economy to go down by 5%. So imagine what could happen, when we take into consideration, the shutdown in April and May. What's going to happen to the economic output in the second quarter? Many economists, as you will see in the table that I'll show later, that they believe the second quarter is going to go down by somewhere between 30 to 40%. That's based on, so let's take a look at some of the recent numbers to see if that actually could be the case. If you look at retail sales is a big part of consumer spending, and consumer spending makes up about 65% of the economic output. So if retail sales actually go down, consumer spending will go down, and that will lead to a decline in the economic output. So take a look at what happened in March. Retail sales has went down by 8%, and then follow up, and drop another 15%, close to 15% on a month-to-month basis. Now, yes, with the reopening of the many states, including California, the May retail sales actually bounced back by about 18% or so. But when you compare it to the previous year, the 18% bounce back is an improvement from the previous month, from April. So, but if you look at it by year-over-year basis, it is still down compared to last year by about 6%. So we're still seeing some decline in these months, and we don't have any June's number yet, but June's number could be somewhat comparable to May, and as such, we are going to see some decline in economic output and GDP. Whether it is going to be 30 to 40%, that we'll have to do more calculation on it. But it is very possible that we may see a steep decline in the second quarter, much bigger than the first quarter. And the decline, can also be, when we take a look at some of the other indicators, we can understand, how concerning it could be. If you look at the indicators, the labor market, the unemployment rate, for example, we received some unemployment numbers earlier today, and it shows that we have unemployment rate at 11.1%. 11.1% is a very, very big number, but when you compare that to the previous month and a month before, it actually is a surprise drop. It actually fell more than what we expected, more than what economists expected. Previous month was somewhere around 13.5%, and the month before that was a little bit higher. But we're seeing a little bit of a drop off because of the reopening. If you look at the jobs being increased in May and June, you can understand why there might be a decline in unemployment rate. May numbers, actually May jobs increase in jobs in May increased by 2.7 million, and then follow up by the latest number of 4.8 million. That's great news, but at the same time, you got to take it with put things into perspective. Take a look at what happened in April. When we had the shutdown, we actually had a decline of, we lost 20 million jobs. So an increase with an improvement, a job growth improvement of 2.7 million, and then a 4.8 improvement, we're still short by about 15 million. Now, don't take me wrong, this is encouraging news. We're seeing some improvement in the labor market. That's great, but also have to be concerned about what could be coming up with coronavirus resurgence seemingly not going away in the next couple of days or so. It may slow down the economy and could actually have an impact on the labor market. We have already heard, from the news that some restaurants and bars have to close in order to clamp down the spread of the coronavirus. So there could be some more unemployment coming our way in the next week or so. And as I mentioned, we're still short about 15 million. So it's going to take some time for us to recover. Let's take a look at some of the more recent number on a weekly basis. That will give us a better picture of how the labor market, the employment situation is doing. If you look at the number of people who file unemployment benefit insurance claim, this is a chart that shows that when at the end of March, when we had the outbreak and the pandemic, the shutdown, the number of jobless claim who file for unemployment insurance surged significantly from 300,000 all the way to 3.3, and then all the way to almost 7 million. That's the number of people who file claims for the first time. Now that number continued to decline in the next 13 weeks or so, And the latest statistics shows that we have gone down to below 1.5, but it is still 1.5 or close to 1.5 million, and it doesn't seem to be slowing down that much in the last few weeks or so. Now, some of these people who filed claims probably have gone back to work and they get rehired. So not all of them are applying for unemployment benefit, but there are still about 20 million people who are still receiving unemployment insurance claims. And again, that number continues to stay high at close to 20 million. Um, the labor market for the U.S. is about 165 million. So 20 million out of 165 people are out of jobs. That's a significant number. That's a double digit, somewhere between 12 to 13% of people who are unemployed. And in the state of California, we also have a dire situation in the labor market. At the beginning of March, the number of people who filed unemployment, roughly on a weekly basis, about 44,000. That shot up significantly to over a million, and then from that point on, a decline. Even today, though, the latest numbers suggest that we are 6 or 7 times higher than what we were at the beginning of March. So that number is not going to go away. It seems like it's leveling off a little bit. Well, every bit of encouraging news would boost the consumer confidence, and it did. With the reopening, with the stock market earlier this month or early in June, showing some signs of life, it started bouncing back a little bit. But then, of course, we also have some bad news in the last couple of weeks. So it is very possible that despite the fact that we had an increase in consumer confidence in the month of June, that number may not necessarily be sustainable, or maybe we won't see a surge again. It may actually stay at a similar level next month. We'll find out, in the next couple of weeks. So what about the market? We look at the big picture. We look at the economy. So what happened to the market? Let's take a look at the market. Now, we have more recent data. We have some weekly data, and we have some monthly statistics. Let's take a look at some monthly statistics first. Now, I know that the monthly statistics is sort of like looking in a rearview mirror, because those sales that closed in May are people who are interested in buying a home in April and open escrow in April and then close in May. So this is a little bit outdated, but we will have some more recent data after showing you the monthly, because the monthly, gives us a sense of where the market is going, and then we want to see, how it will pan out, in the upcoming months. So let's take a look at May's number. You look at May's number, you notice, the sales actually went down quite significantly. It did go down in March, in April, and now in May by 41.4%. Because we have sales have gone down for 3 months in a row. For the first 5 months of the year, we actually are down about 13% compared to the same time last year. Price-wise, it also has gone down at the state level by close to 4%. On for the supply side, it's remained tight at 4.3 months. Normally, 3 months, 4 months is actually very, very tight. I know in the Bay Area, it's even tighter. Bay Area is 1 to 2 months. I'll show you those numbers in a minute. For the time of market, it stay on the market for about 17 days for a property to sell, and then the sales to list price ratio is virtually flat. So closed sales suggest that we are of course it went down significantly, but more importantly, we should look at the pending sales number. Pending sales number in May suggests that will give us an idea what's going to happen in June, because those are sales that were closed in June or maybe July. Take a look at pending sales. It's more encouraging. The pending sales at the state level in May shot up significantly on a month-to-month basis by 67%. That's pretty impressive. That suggests that we are doing a little bit better. And in fact, when you compare that number, pending sales compared to last year, in April, if you take a look at the number right here, it shows pending sales in April dropped 43%. That's actually a good reflection of what happened to closed sales in May, because pending sales that closed open and escrow in April, closed in May actually drop 41%. So that's a good reflection of what happened in closed sales. What about pending sales in May? Now, pending sales in May dropped 5.5% compared to last year. That suggests to me that in June, we probably will see a single-digit drop in closed sales. Now, it's still a drop, of course. It's still a year-over-year drop. But hey, compared to what we saw in March, April, the sales dropping, 40, 30, 40%, I'll take it. I'll take the 5.5%. And up in the upcoming month in July, we'll take a look at some pending sales in a minute to see what's going to happen in July. But before we do that, let's take a look at some regional numbers. I know Bay Area has a lot of high-end home sales, a lot of expensive home, and expensive home or luxury homes or high-end home, I should say, are actually in March and April, they were not doing as well. And May also, compared to the state number, the Bay Area sales number actually dropped quite significant, a little bit more significant than the state. State, again, dropped 41%. Bay Area dropped 51, 52%. So that's a little bit more significant. Now, but fast forward a little bit, let's take a look at more recent weekly number of closed sales. That's a little bit more encouraging. If you look across the 9 counties in the Bay Area, Alameda, Contra Costa, if you look at how they have been trending, it bottomed out, a few weeks ago. It started trending up. We started seeing a little bit of trend up in sales. Take a look at these numbers on a weekly basis. It started trending up in most counties, and in Santa Clara County, it actually went up quite a bit, to the highest level probably a couple of weeks ago. Now, these are average daily closed sales for that particular week. So we are seeing some uptrend, and but if you take a look at the latest week, we're seeing a little bit of slowdown in some counties. In East Bay, for example, Alameda dropped a little bit, Contra Costa dropped a little bit, but you see some improvement in some other areas like wine countries, Solano and Sonoma, Napa. So all in all, I think we will see a better month in June for the Bay Area and possibly in July. Let's take a look at pending sales in a minute. But let's take a look at the month-to-month comparison first. As I mentioned, slow down in the East Bay, but some improvement in the wine country. What about pending sales? Pending sales again will reflect what's going to happen, 30 days from now. So we have some weekly number for the week of the last week of June. Again, we have been seeing some uptrend in pending sales, but the latest week seems to slow a little bit. So it seems to be showing, a similar or consistent trend as what we saw at the state level and some other region. Slow down in the East Bay, but we still see, some uptick in some of the other areas. So it may actually end up being, somewhat even, in the Bay Area as a whole. But it looks like, we are seeing some slowdown in East Bay. So July sales might be a little bit soft in the East Bay. But hey, here's just 1 week, 1 week of a blip of leveling off. So we don't know whether this leveling off is due to it could either be due to the concern about coronavirus upsurge in cases, or it could be because of the lack of supply. We're concerned about lack of supply all the time, but we also could be the housing market, home buying season actually coming to an end. Typically, the home buying season is between April to June, and then we got some closing and things like that, in July. And we have always been hoping that, because of the shutdown, that home buying season will stretch a little longer, maybe to August or so. But that might not necessarily happen. So we have to keep monitoring, the weekly number, and we'll report back, when we report our next update to you guys. So again, mostly flat, mostly down, but flat. The encouraging news, of course, to the housing market is we have been getting very, very low rates, low mortgage rates. Rates for 30-year fixed rates on average in the last couple weeks or so, we have been seeing like 3%, 3.1%. So very, very low rates for the market. And low rates will encourage people to buy, especially when you take a look at this number. Now, this is a state number based on the state median price, the statewide median price, which dropped by 3.7%. If we apply the 30-year fixed rate or prevailing mortgage rates to the statewide median home, we'll end up paying about 13.2%, low mortgage payment compared to last year. Now let's take a look at, what happened at the state level. At the regional level. As I mentioned, at the state level, here's the actual amount. This year when you with the current median price, you apply the lower 30-year fixed rate to the current median price, you actually end up paying a mortgage payment on a monthly basis by 2040 at the state for an existing single family home. Last year, which has a 30-year fixed rate about 80 basis point higher than the May of this year, you end up paying about 2,350. So compared to last year, where you actually save, if someone were to buy a house that is similar to what they purchased last year, they end up paying 13.2% less mortgage payment. So that's a very encouraging sign for home buyers, and I think that's the reason why a lot of home buyers, rush into the market in the last month or two to cash out, to actually buy a property. Of course, most of those, I would say, hopefully all of those are buyers who are financially capable of buying a home, and they were able to capture a piece of the property. And capture it on the best time to buy a house. What about Bay Area? If you look at Bay Area, you actually save about the same amount in terms of percentage. Last year, you pay for a typical home in the Bay Area region, you pay about a mortgage payment of $3,810. This year, with a much lower interest rates, you pay $3,350. You save about $500 to $450. And that's about 12%. So that's why, for many people, many financially capable buyers, this is a good time to buy. As I mentioned, the median price actually dropped 3.7%. It's actually the first drop that we have seen for quite some time, since 2012. And we had a good run in terms of, price increase for 8 years or so. And of course, the pandemic situation kind of scare a lot of people away, and actually a lot of buyers, based on our survey study, think that they can actually get an even more bargain, in terms of price. I think part of the reason is, many believe that the shutdown is going to cause a lot of sellers to panic. But in fact, a lot of sellers decide to hold back on properties instead of quickly rushing in to sell the properties. So we'll talk more about that in a minute. Now, if in terms of price decline for the state as a whole, yes, we dropped about 3.7%, but individual price point actually is a little different. If you look at the tightest, most affordable price point, the 20th, the lowest 20th percentile, which is probably the price range between 0 to 304, 300 to 350. People are actually prices continue to grow by 0.4%. Now, I know that doesn't necessarily apply to many of the counties in the Bay Area. It might apply to Solano and Sonoma, but for many properties in the Bay Area, it's probably fallen into this range, which unfortunately we're seeing a little bit of decline in price in the last in May or so. June may be a little different, but even with the decline in price, it's not actually dropping that much, but just by about 3.3% or so at the highest price range. Another reason why we're seeing a 3.7% drop in price is also because of the change in mix of sales. We're seeing softer sales, at least in April, March, maybe in May, and the upper price segment. So that's actually shift, the median price more towards the lower price segment, and that's why you see a little bit of a drop in price at the state level for the median. Now, 3.7% is actually not a huge drop, and if you compare that to what happened in the Great Recessions in 2008, 2009, that actually dropped more precipitously by about 10, 11, 12%, very significantly. And the reason why we're seeing more support and price is because of active listings. Active listings continue to be tight, and it remained tight for the last few months or so. In fact, it has been constantly dropping on a year-over-year basis by 25% or more, with the latest month dropping 34%. That actually tightened up the supply and put some upward pressure on home prices. Um, let's hone in a little bit on the regional numbers. If you look at San Francisco Bay Area, the supply in the Bay Area as a whole dropped from 8,000 to 5,800, dropped 2,000, more than 2,000 active listings. And in terms of percentage, it dropped about 27%. But if you take a look at how it compares to other regions, it's actually not dropping as much as Southern California and Central Valley. It is just a little bit above Central Coast. So it has it probably is because in the Bay Area it has already had very, very tight supply and to start off with. That's why we're not seeing that big of a drop. Let's again take a look at some more recent numbers and see if we can understand a little bit more and get a better sense of where we're going in the upcoming months. If you look at new listings, here we have all the 9 counties here. I know it's a lot of bars here. It might be a little hard to see. These are average daily new listings added to the MLS. If you look at the last bar, which is this orange bar, you can see in some areas we're seeing some drop, some areas we're seeing some improvement. The one that I noticed the most is Santa Clara. Santa Clara continued to improve once it's actually bottomed out in the first month or the mid of April. It started adding a lot of new listings, even as of the latest week, started increasing to the highest level of new listings. In fact, in the last 3-4 months. Some other areas are also improving, like Solano's improving, but some other areas are dipping as well as active listings, like Solano, San Francisco, and the East Bay as well. So there are more new listings in Santa Clara, but overall we're seeing a little bit of going back and forth between counties. Some counties are doing better, some counties are not doing as well as far as new listings. But again, the Bay Area is the tightest area, so I think we probably will continue to see a little bit of supply constraint, or quite a bit of supply constraints in the upcoming weeks. Now, there are other indicators that also show, the market is actually doing a little bit better compared to before. So let's take a look at some of those other indicators. Showing activities, this is a state level number. Showing activities also show that we're doing a little bit better. If you look at the showing activity from showingtime.com, the orange line shows, how the weekly average is compared to the beginning of the year. For the orange line, in March, after the shutdown, we saw weekly average drop significantly by 60-70% compared to the beginning of the year. But then from that point on, we started seeing, some increase in showing, probably because people figured out how to actually show their properties virtually, how to conduct transactions virtually. We started seeing a little bit more, and then we started seeing the this year's level surpassing last year's level around late May, early June. In fact, if you look at today's number, the latest statistics suggest that we are actually above last year's by 55%, which is very, very impressive, given that we actually had a significant decline a couple months ago. The other indicator that actually is somewhat encouraging is the purchase applications. Mortgage purchase applications are showing a pretty decent month-to-month, year-over-year decline, year-over-year increase, with mortgage rates at very, very low rates, record-setting level. We consistently see last few weeks, the mortgage applications, purchase applications, a double-digit increase from last year, which is very impressive, which suggests to us that in the next couple of months, we may continue to see some improvement in the housing market. It may still be below last year's level, but we're seeing some improvement. Let's take a look at what we think, in terms of the economy and in terms of the housing market. If you look at the decline, if you look at the economic output, you see that there's going to be a decline in the second quarter, as I mentioned earlier. Many economists believe that in the second quarter, we're going to see a drop. UCLA, for example, believe that we're going to drop quite significantly by 42% compared to the quarter before. That's huge. That's a significant drop, and that's because of, like I said, the shutdown, and also potentially there is a surge in new cases. But it's going to bounce back in the third quarter and the fourth quarter. But even with the bounce back in the third and the fourth quarter predicted by many economists, I think for the year as a whole, we believe that it's going to be down about 5 to 10%. What about the housing market? Housing market is actually the bright spot, for the economy. Here's one scenario. We haven't finalized our forecast, but here's one scenario. We believe that the May sales number dropping 41% is probably the bottom, and will bounce back in June, and will follow with some return in July and the rest of the year. Now, we still think that for the rest of the year, it will probably end up with a decline compared to the year before, but the decline will be much smaller than what we have seen in the past couple months. Price-wise, again, it's supported by supply. I think we have tight supply situation, but also low interest rates also help. Home prices will likely remain soft for the rest of the year. It may drop so it dropped about 3.7% in May. It probably will continue to drop slightly, in the upcoming months, and for the rest of the year. But even with that drop, for the rest of the year, it's going to be small, probably between 3 to 5%, maybe even less than that. I think we're a little bit more conservative with our estimates here. So it could actually be surprise us on the upside. But for the year as a whole, if it follows this trend, we believe that it's going to drop a little bit less than 2%. And so with that said, let's wrap it up. I'll give you some highlights and some key high points of what we discussed. First, I think the economy is going to bounce back. It's going to take some time, but it's going to bounce back. It may not be this. It's definitely not going to be this year. It will take more than just a year or two. I think we at the end of next year, we probably still will not recover to the level of what we saw earlier this year. And another uncertainty that we have is, of course, the coronavirus resurgence. We're seeing a little bit of a surge in new cases. Hopefully, we can keep it under control, and then we can slowly get back to normal. But it's going to take some time, as I mentioned. The housing market, we're seeing some sales demand coming back, but we're also seeing a little bit of leveling off. Whether that is sustainable or not, we'll have to continue to observe and see whether that is going to bounce back or continue its decline. But the one thing that we're certain is supply. Supply is very, very tight, and that will contribute to a decline in sales, but it will also help prices remain from dropping too far. And we do believe that prices will continue to soften, but they probably will not be softened too much. The housing market, as I mentioned, continue to be a bright spot, and we believe that it will help lead the economy out of the slum. But again, time is we will need some time, and hopefully we'll get through this very, very quickly, and we will get back to a little bit more normal very shortly. With that said, we will continue monitoring the market, and we'll give you another update in a few weeks. Have a good week, and stay healthy and stay safe. Bye-bye.